While the world focused on booming equity indices and Nobel-backed financial genius, the real event happened inside a quiet office park in Greenwich, Connecticut. There were no crowds, no alarms, no trading floor chaos, only spreadsheets, leverage models, and contracts that assumed the world would behave. On paper, risk was dispersed. In reality, it was concentrated. Long-term capital management did not fail because markets were irrational. It failed because markets were physical and its positions were not. Billions in paper claims were stacked on assumptions of liquidity, perfect arbitrage, and uninterrupted margin financing. The models worked until they met balance sheets, vaults, and counterparties who could not exit at the same time. This is not a story about bad bets. It is a story about system stress, hidden leverage, and how quickly confidence becomes default risk. The collapse was not sudden, it was procedural. And once the mechanism engaged, the outcome was no longer a prediction, but an inevitability. What appeared to break was nothing at all. Screens were calm, volatility was compressed, yield spreads narrowed, equity indices advanced in orderly increments. To the public, this was stability, evidence that risk had been priced, absorbed, and neutralized. What actually happened was the opposite. Beneath the surface, leverage accumulated quietly. Arbitrage trades multiplied across institutions, all calibrated to the same assumption, that price relationships would converge smoothly and that liquidity would remain continuously available. The signal everyone trusted was the absence of disruption. Silence was interpreted as strength, but silence was the product. It was manufactured by scale. The mechanism was simple and mathematically implied. A. Stable prices created an arbitrage incentive. Small mispricings could be harvested repeatedly, but only with size. B. Size required leverage. Leverage required margin. C. Margin was cheap because volatility was low. Liquidity appeared abundant. D. As more capital crowded into the same trades, liquidity was not added, it was removed. This is the Q analogy. As long as the line does not move, everyone assumes service is infinite. But the line only exists because capacity is finite. When one participant steps back, the entire queue compresses. In this environment, paper claims multiplied faster than the underlying market could absorb. The trades worked because they were small relative to perception, not reality. Each position assumed an exit that could only exist if no one else used it. That assumption was false. At this stage, escalation was invisible but already in motion. Margins did not rise yet, but they thinned. Liquidity did not vanish, but depth declined. Risk models did not fail, but they converged. This is the same precondition observed before the 1980 silver rule change, when concentrated positions appeared stable until position limits exposed physical scarcity. It is the same rhyme heard before the 2008 liquidity freeze, when repo markets functioned, until they didn't. No halts were announced, no rules were changed. That was the signal. Because rule changes only arrive after the mechanism has already engaged. The real-world indicators were subtle and therefore ignored. Dealer balance sheets stopped expanding. Bid-ask spreads narrowed on screen, while actual executable size declined. Inventory classifications shifted internally from readily available to conditionally available. There were no headlines about delivery delays, no discussion of inventory quality, no mention of how much capital would be required if positions needed to be unwound simultaneously. Industrial demand did not spike. Nothing dramatic occurred, and that was the point. The system was calm because it was fully loaded. Every position depended on the same quiet assumption, that liquidity would be there tomorrow because it was there today. What visibly broke was a peripheral market. What actually broke was the assumption of independence. To the public, the event appeared distant and contained, a sovereign debt disturbance in an emerging market, reported as isolated, regional, manageable. Screens showed volatility, but only in the affected instruments. Commentators described it as idiosyncratic. Inside the system, correlations snapped into alignment. The moment Russia suspended payments on its domestic debt, price relationships that were treated as probabilistic became binary. Assets that were never meant to move together began doing exactly that. The distinction between safe and risky compressed. The distinction between unrelated markets vanished. This was not a shock, it was a reveal. The causal chain was direct and unavoidable. A. Sovereign default repriced risk globally. B. Spreads that were expected to converge instead widened violently. C. Arbitrage positions moved against themselves across multiple legs. D. Margin requirements increased simultaneously at multiple counterparties. The arbitrage incentive had assumed dispersion. What arrived was synchronization. This is the bottleneck analogy. Traffic flows smoothly until one lane narrows. The slowdown is not local. It propagates backward through every connected road. Liquidity was not withdrawn by panic. It was withdrawn by mandate. Risk desks recalculated exposure using updated correlations. Haircuts rose. Financing terms tightened. The same trades, held across institutions, were now competing for the same shrinking exit. Paper claims still existed. Liquidity to settle them did not. The escalation followed a familiar historical pattern. First came margin hikes, justified as temporary adjustments. Then came position reviews, framed as routine risk management. Then came informal halts, where markets remained open but size could not move without penalty. This mirrored the early days of the 2008 liquidity freeze, when markets technically functioned, but only at prices that forced losses. It also rhymed with the 2022 nickel halt, where correlation failure forced exchanges to intervene after the fact. At this stage, no formal rule changes were announced. But internal rules were already being rewritten. Each step increased system stress because each step reduced optionality. What could not be exited today would be harder to exit tomorrow. The physical indicators confirmed the shift. Dealers quoted prices but capped size aggressively. Premiums appeared off-screen, negotiated privately. Settlement windows lengthened. Inventory classifications became critical. Assets once treated as immediately deliverable were reclassified internally, reflecting liquidity risk rather than availability. Eligible assets remained on balance sheets. Registered assets became scarce. Industrial demand did not drive this phase. Institutional demand did. What mattered was not consumption, but collateral. What could be pledged? What could be rehypothecated? What could survive another margin cycle? The screen still showed prices. The system no longer trusted them. What visibly broke was performance. Returns reversed. Losses appeared. Drawdowns accelerated. What actually broke was time. To the public, this phase looked like a bad month, then a bad quarter. A sophisticated fund experiencing volatility, nothing unprecedented, nothing systematic. On the inside, however, positions that were designed to be held patiently were being evaluated minute by minute. The trades were still theoretically sound. The prices were not. At the center sat long-term capital management, holding positions so large that exiting them would define the market rather than follow it. The causal chain tightened. A. Spread widening reduced mark-to-market valuations. B. Reduced valuations triggered margin pressure across multiple counterparties. C. Margin calls demanded cash, not theory. D. To raise cash, positions had to be sold into the same market that was already moving. This is the margin call analogy. A homeowner can afford the house until the bank demands additional collateral. The asset hasn't changed. The financing has. And financing decides survival. Arbitrage strategies depend on small price movements resolving over time. Leverage removes time from the equation. As financing costs rose and collateral requirements increased, the fund was forced to act against its own logic. Liquidity did not disappear everywhere. It disappeared where it was needed. Every attempted reduction in exposure widened spreads further, worsening the very metrics used to justify the margin calls. The system fed on its own feedback loop. Paper claims remained intact. The market to exit them did not. Escalation accelerated visibly now. Margins were hiked again. Financing tenors shortened. Credit committees overrode trading desks. There were no exchange halts yet, but functional halts emerged. Trades could clear only in trivial size or at punitive prices. This mirrored early 2008, when markets stayed open but ceased to function as liquidity venues. Rule changes were not announced publicly. They were enforced privately. Each adjustment increased stress because each reduced degrees of freedom. What had been a portfolio problem became a funding problem, and funding problems do not resolve themselves. At this point, force majeure risk entered internal discussions, not as a legal claim, but as an operational contingency. The physical indicators became impossible to ignore. Dealer balance sheets contracted. Repo rates diverged by counterparty. Collateral haircuts varied by instrument quality, not just type. Inventory that had been assumed interchangeable was suddenly tiered. The best collateral stopped circulating. The rest accumulated, unusable for margin relief. Delivery timelines stretched, not because assets didn't exist, but because no one wanted to release them under stress. Industrial demand was irrelevant. What mattered was survival through the next margin cycle. The screen still updated prices in real time, but those prices could not be realized at scale. What visibly broke was confidence. Funding lines were questioned, credit terms were reviewed, conversations shifted tone. What actually broke was model authority. To the public, this phase barely registered. There was no single headline event, no exchange halt, no announced default. The system appeared to function. Trades cleared, prices printed, markets opened each morning. Inside the institutions, the atmosphere changed. Risk committees stopped asking how trades worked and began asking who else held them. Exposure was no longer evaluated in isolation, but in clusters. The problem was not losses, it was the unknown. The causal chain was institutional and recursive. A. Losses triggered internal exposure reviews. B. Reviews revealed overlapping arbitrage positions across firms. C. Overlap implied correlated liquidation risk. D. Correlated liquidation risk forced preemptive liquidity withdrawal. This is the vacuum analogy. Air does not rush out because of motion. It rushes out because pressure changes. Once pressure drops, everything moves toward the void. Liquidity was removed defensively, not emotionally. Banks reduced credit not because they expected failure, but because they could not measure exposure precisely. Financing was curtailed across desks simultaneously. The same models, once trusted, were now treated as common points of failure. Paper claims were still valid. The willingness to fund them was not. Escalation crossed an institutional threshold. Margins were raised unevenly. Financing was shortened selectively. Certain positions became effectively non-fundable. No formal halts were declared, but internal risk limits functioned as circuit breakers. This mirrored the quiet phase of the 2008 liquidity freeze, when markets froze not through policy, but through caution. Rule changes began to surface indirectly. Balance sheet usage was repriced, capital charges increased, trades that had been acceptable weeks earlier were now prohibited. Each step increased stress by concentrating risk further. Positions that could not be reduced became more dangerous precisely because they remained. Physical indicators confirmed institutional retreat. Dealer quotes fragmented by relationship. Premiums emerged off-screen for immediate settlement. Some collateral was accepted only at steep discounts. Inventory classifications hardened. Assets were sorted not by market price, but by funding utility. Eligible inventory sat idle. Registered inventory became untouchable. Industrial demand played no role here. This was a balance sheet event. The silence was the signal. Markets were still open. But the institutions that made them function were pulling back. At this stage, panic was not visible. It was procedural. And procedure was accelerating toward intervention. What visibly broke was autonomy. What actually broke was the boundary between private failure and systemic risk. To the public, the episode was framed as coordination, a group of sophisticated institutions managing a contained problem. There was no government bailout, no emergency legislation, no visible intervention in markets. Behind closed doors, the system acknowledged something else entirely. The failure was no longer about one fund, it was about the price discovery mechanism itself. Forced liquidation at scale would not merely harm participants, it would redefine valuations across global markets. That outcome was deemed unacceptable. The causal chain moved from markets to governance. A. Continued margin pressure implied imminent disorderly liquidation. B. Disorderly liquidation implied market-wide repricing. C. Market-wide repricing implied institutional insolvency risk. D. Insolvency risk triggered coordinated intervention. This is the bottleneck analogy at the system level. If too much volume is forced through too narrow an exit, the structure fails, not the traffic. Arbitrage positions could not be unwound without collapsing the very spreads they depended on. Liquidity was insufficient to absorb exit margin requirements, made delay impossible. The only remaining variable was control. At this point, financing terms no longer reflected risk. They reflected survival priorities. The decision was not whether losses would occur. It was where they would be absorbed. Escalation reached its final procedural stage. Informal trading halts became explicit coordination. Private rule changes replaced market rules. Positions were frozen, transferred, or guaranteed. This rhymed with later events. The 2008 crisis, where emergency facilities replaced interbank trust. The 2022 nickel halt, where exchanges retroactively altered outcomes to preserve function. The lesson was consistent. When leverage meets illiquidity, rules follow stress, not principles. Force majeure was no longer theoretical. It was simply avoided this time through containment. The physical signals confirmed intervention. Markets stabilized without genuine liquidity returning. Spreads narrowed without volume. Prices recovered without participation. Dealer inventories did not normalize. Balance sheets did not expand. What changed was ownership of risk. Assets moved from leveraged hands to institutional balance sheets capable of absorbing time. Paper claims were honored, but only because the system chose continuity over liquidation. Industrial demand remained unchanged. Physical conditions were untouched. The screen suggested resolution. The underlying structure had not healed. The precedent was set quietly. What visibly broke was the narrative of resolution. Markets reopened. Prices stabilized. Losses were tallied. The episode was declared contained. What actually broke was the illusion that capital is infinitely mobile. The positions still existed. The exposures still existed. They had simply been transferred to entities with longer time horizons and stronger balance sheets. To the public, this looked like success, a near failure avoided, a system that bent but did not break. In physical terms, nothing had been resolved. Risk had been warehoused. The final causal chain was structural. A. Paper claims were preserved through coordination. B. Preservation required balance, sheet absorption, not market clearing. C. Absorption removed risk from screens but not from the system. D. The underlying liquidity constraint remained unchanged. This is the vacuum analogy, resolved. When pressure becomes too great, the system does not equalize, it seals. Movement stops, not because equilibrium is reached, but because flow is no longer permitted. Arbitrage depends on circulation. Liquidity depends on willingness. Margin depends on trust. When any one of these fails, the rest follow. In this case, circulation was replaced with custody. Time replaced liquidity. And the price signal lost meaning. Paper claims survived because they were honored administratively. They were not tested physically. This was the final step of escalation, deferral. Margins stopped rising because positions stopped moving. Halts were unnecessary because liquidation was suspended. Rule changes became permanent expectations. This is the historical rhyme that follows every crisis. After 1980, position limits became doctrine. After 2008, liquidity facilities became standing tools. After 2022, retroactive intervention entered the playbook. Each response reduced immediate stress while increasing future system stress, because each confirmed that when physical limits are reached, the paper system will be protected, not repriced. Force majeure was avoided, but the conditions that require it were normalized. The real-world indicators told a different story than the screens. Dealer inventories remained constrained long after prices recovered. Balance sheets stayed selective. Risk premiums lingered off-screen. The distinction between eligible and usable assets hardened. What mattered was not ownership, but deployability. Assets existed, but they did not circulate. Industrial demand was unchanged. What had changed was the system's tolerance for strain. Delivery timelines normalized only because delivery was no longer demanded at scale. The test never came. That absence was misread as stability. The screen showed closure. The physical system showed fatigue. This was the quiet conclusion.